Hey guys, it's been a little while since we did a Misfit Monthly with our good friend Tyler Crow at Misfit Alpha, but we're back with Misfit Monthly 4. Hey Tyler, how's it going?
It's going good, Jason. We'll chalk it up to the fact that we were in Omaha last month, and like by joining you guys on a live stream. We'll say that we did it, but maybe just not in the normal way.
The funny thing is that we actually came out of Omaha with a lot of momentum and great ideas. And we got positive feedback in person from a lot of people that told us they liked what we were doing, bringing the Misfit Monthly episodes into the rotation. And then we immediately don't do it for over a month. So, hey,
well, life happens.
That's how things go, but we're definitely back, and I'm excited to have you here again. So we're tentatively calling this episode, and I so hate it and regret that these words are going to be coming out of my mouth. We're tentatively calling this episode Jeff Was Right.
Yeah. So a couple of weeks ago, you and Jeff did a show on the idea of it's harder to find an edge.
Yeah. That was episode 156. Is it getting harder to find an edge? Right.
Fortunately, instead of being the longtime listener, first time caller, I get to actually have a monthly show where I get to have conversations with you guys about this, which is nice. It's like, you guys are like an old New York radio sports show. I get to call in and give my thoughts on what you guys do. So I was listening on the less efficient market hypothesis, and there was a paper that I had read, and one that had gone around the social media channels from time to time, if anybody is in value investing, that as Jeff was speaking, it kind of I immediately came to this paper, and it was like a discussion I wanted to have, because I agree with Jeff. It kind of ties into this paper and kind of gets into why this Misfit go fish in weird ponds, look in different places.
The paper you're talking about, this is from Cliff Asness, who's the co-founder of AQR Capital Management. And the title of the paper, and I believe it came out just this past fall, I don't think it's been around very long, is The Less Efficient Market Hypothesis. We'll put a link in the show notes to that. And the background too, just in case there's anybody that's listening that hasn't, it might be a good idea to go back and listen to episode 156 before you listen to this one. But the whole idea of that show, because it was a catalyst of a blog post from Ben Carlson of A Wealth of Common Sense fame, his blog, who we've had him on the show too. But the idea that if you look at some of the data, Tyler, there's evidence that could support the idea that the market may be becoming a little bit less volatile. Downturns may be a little bit less severe, almost like after years and years of telling individual retail investors, hey, think long-term, buy the dip when there's a dip to buy, hold on, let time do the hard work for you, right? The catalyst was in April. We saw, I think the number was like $40 billion of new cash flowed into the market from individual investors, right? The largest in history, and screwed up a perfectly good market sell-off that could have turned into a nice bear market for us patient investors. And the market's turned around largely since then. So again, that was the idea, is that all of those things are the catalysts behind us. That was the idea for the conversation that Jeff and I had. So let's talk about Cliff Asness's paper, what it says, and what you believe about it to be true.
We'll try to tie as much of this as we can together from the previous conversation. Is the idea that very buying that you just talked about, with the buy the dip mentality that we're getting from retail investors, is, yes, it's creating less volatile situations and not giving us the bear markets that we want to have. But kind of the argument also being is that it's creating larger price discrepancies in the market, meaning that the market may not necessarily be as efficient as it used to be, in large part because people are playing a slightly different game.
Yeah. Because the idea, technically, the smart money better knows what things are worth. Should.
Right. In theory, yes.
Right.
But the idea being is that there's a lot of reasons that stock pickers, value investors, people who have been doing active management for a long time, even quant firms like AQR Capital Management part of it has been this, they've all been kind of grumbling. It's like, oh, it's indexing's fault because everyone's just piling money into the same indexes all the time. Or there's a multitude of reasons, and all of it just kind of sounds like grumpy value investors complaining because they've been underperforming for a really long time. But
instead of old man shouts at clouds, it's value investor shouts at retail.
Yeah, for being like, well, why I'm right. Why are you not paying attention to me and buying this 10 times earnings company, whatever? It's like we've heard a lot of this stuff and it's like, okay, grandpa, go to bed, go buy your whatever crap business for 10 times earnings. But there were some pretty salient points in the piece, and it gets back to that harder to find an edge. He was talking about over the past 30 years, there's been some prevalence or bubbling up sort of things in the market in the way that investing has happened that has changed over 30 years to make the market slightly less efficient. And efficient being like money flowing to the best opportunities based on pricing of assets. So meaning if you are actually buying a stock, you're buying it not just for its future growth prospects, but the price that you have to pay for those future prospects. In that sense of like, I think a great example of this, and it's one that you guys have talked about a couple times, is Costco. Costco's a wonderful business. It's hard to argue that strategically, there's probably like maybe 2 or 3 retailers you could maybe make an argument is better than Costco. But it's really splitting hairs on who's the best retailer out there. And with Costco's business model, it's one of those ones where it's like, it's hard to go wrong. But then you look at the stock and it's 50 times earnings.
Excuse me, it's 56 times earnings.
I was going off the top of my head. The fact that I got it within the ballpark, I think is pretty good. Costco's a wonderful business. And I'm glad for a lot of people that have owned the business for a long time and probably made considerable returns for it. But adding new money to what is a quality but low growth business at 56 times earnings doesn't seem like the most reasonable place to put your money. And so this is kind of that efficient market. You want to price into something that is going to have a reasonable return in the future based on not just, multiples going higher. And so the idea being is like the more efficient market, I guess, if you will, is some of that money that is going into Costco at 56 times earnings is instead going into the cheaper priced stocks that have good looking returns over the next several years. But that hasn't been the case. And some of the numbers that they were giving in this paper show that the spreads between like growth versus quality, and growth being like highly valued companies versus cheap companies, is some of the widest we've seen in 50, 60 years. Using some of the Chicago School of Business thesis, or Eugene Fama, he's kind of the efficient market prophet from University of Chicago. He does a lot of work in this regard, and some of the things that they have been plotting over the past 50, 60 years shows like the value spread between, growth versus value. And even during like the kind of the 2021, 2020 mania that we saw in the market, the spread between like value and growth then was higher than the .com boom. And we're still trending historically high in a lot of these regards. And so
I want to unpack a little bit about, just for investors who are still trying to wrap their heads around the idea of valuation and what the idea of efficient market theory really means. We'll start with efficient market theory. My shorthand definition is that the idea that the markets are efficient, I think, is largely BS in terms of their ability to rationally be efficient, right? But I do think that the thing the market is very efficient at is taking whatever information is available and applying it, right?
Yeah.
Doesn't mean the information's valid, but it certainly seems to apply it very quickly.
Maybe for like individual long-term investors, maybe somebody who isn't doing trading and things like that, instead of thinking of it as the efficient market thesis, we can think of it as the responsive market thesis.
Yeah.
Where the market is quick to respond to all information available in a given company. And that's efficient market thesis. Like the really shorthand, like social media version of an efficient market thesis is it's all priced in, bro. Like every single possible scenario for here until eternity is priced into the stock. That's kind of this, Zen-like view of efficient market hypothesis. It doesn't matter. It's all priced in. And that's kind of like the crazy version of the efficient market hypothesis. However, and as you were kind of getting at, for individuals who are long-term investors, it's kind of BS, right? Because it's assuming that everyone is correctly interpreting all the information all the time. And that's where it goes from being efficient market to responsive, because it's just quickly price in all of the news. Doesn't necessarily mean it's the most reasonable way to be priced in.
Yeah, just one example of the difference between being efficient and being responsive. We could use Enphase stock today. We're recording this. It's still about 20 minutes before the market opens on June 17th. And Enphase stock is down probably 20% in pre-market, pretty close to it, because the spending bill that's bouncing around Congress, some of the incentives for renewables keep getting whipsawed back and forth in terms of what they're going to look like. And the market is responding in a very negative fashion to that, and not necessarily like holistically everything that's going on with these businesses in the US and around the world. So the market's very responsive to that information. Whether it's what it's doing with it is going to be indicative of how it's going to affect the business results is another story entirely.
Yeah, a lot of these things can be very undetermined, right? Because we saw similar things happen with solar stocks in general a few weeks ago when the first draft of the legislative bill came out. And so it's like no renewable subsidies. A lot of solar stocks took it on the chin. And then all of a sudden those subsidies or tax credits started to trickle back into the bill. And then you saw the stocks jump back up again. So again, it's not the most efficient because it wasn't priced. You could say like it was priced in at the moment, but it might not have been necessarily the market, if you will, wasn't necessarily pricing in the dynamic changing of the scenario of the future information that we think is pretty likely out there. And so this is us explaining and kind of dumping on efficient market thesis at the same time. But just to give everyone a sense of what this is. And look, we can make fun of it, but there is a lot of trading algorithms and a lot of high frequency trading, a lot of these, what we will call them now, like prop shops, like Citadels and Millenniums and things like that. A lot of them use a lot of this type of market thesis to build a lot of their very profitable ways of making money. So like, yes, it doesn't work for us as individuals because we can't operate at that scale and at that speed.
Well, it's the whole reminder that as individual investors who are trading on an app on our iPhone in a lot of cases, or buying and selling on an app on our iPhone, that we are not playing the same game that those shops are, where it's all about the velocity of trades and knowing where the momentum is going and being quick in and out and making a handful of basis points. But then you do that thousands and thousands of times over a trading week, those basis points add up, right? And we literally don't have the capacity to compete with that when we're talking like fractions of seconds sometimes where a company might move in and out of a single stock.
No, it's a comparison between us and these big companies trying to do like trading stuff. It's like you trying to dig a hole with a garden trowel and they have one of those industrial scale coal mining strip the mountain pieces of equipment.
Sheer horsepower. It's sheer horsepower and equipment, right?
It can be the same thing there.
I want to talk about the idea of valuation, thinking in growth versus value and breaking that down, because it's another one of those situations where, now this is a case where this is about reaching into your toolkit as an investor and pulling out the right tool. Because if you're doing a valuation of Costco compared to a valuation of CrowdStrike, you might use some of the same tools. Like you're going to use a measuring tape, right? If you're building a house or you're building a chicken coop. But the difference is
metaphors all around today.
Flying everywhere, right?
Yeah.
But the difference is the measurements that you're making, right? And how you're applying the right measurement. So for example, when you're buying a very, very low growth company versus a high growth company, you're buying a high growth company. The idea is you're going to pay a higher multiple because you're buying the business, and the margin of safety is their ability to grow into that valuation, right? Because the trajectory of the business and their cash flows is going to paying 50 times cash flows today for a business that's compounding its cash flows at 30 or 40% a year, with a terminal cash flow per share growth rate over the next decade of 20% a share. That 50 times cash flows is going to work out really, really well when the stock's trading for 20 times cash flows in a decade, because they will have compounded it so much. The other side of the coin on value is if you're paying 50 times cash flows for a company that's growing its cash flows per share 6% per year, that company can't grow into that. So you want to buy that business at a fair to cheap valuation with the idea that you're going to still get good rates of return. And if you can buy it cheap, the valuation is going to grow up, right? Not the other way around. And you're going to get some benefit from the valuation returning to a more normal level. And the risk, again, with the Costco's and that sort of thing, where you're buying them at these elevated levels, is the normalization's the other way. And that's a major headwind to compounding returns over the long term.
Yeah, growth is very much buying what this company is going to be in the future and paying a premium for that. Whereas value tends, or at least thesis on value, is that people are mispricing the opportunity and it's unnecessarily cheap. And so you can get good returns on something that's underappreciated in the market. And this is where we start to trend back to this efficient market thesis idea, is the idea that if you look at the way that the market has been priced in recent years, and getting back to why it seems to be harder, is that the prices for growth are that much higher and the returns for value have been middling, in large part because all the money has gone to growth, right? And so this is where we're getting into that less efficient market hypothesis, is that despite the returns on growth looking more and more challenging, like these companies have to grow that much more and that much faster to justify these valuations.
Hey everybody, we'll be right back, but first a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally, but beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes.
Hey listeners, my name is Brett Schaefer, one of the hosts of the Chit Chat Stocks Podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, we cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors, and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks Podcast on YouTube, Spotify, or Apple Podcasts, and start discovering new investments today.
And it's not that the businesses themselves aren't doing the same high margin compounding of results, growing cash flows per share. All of those things are still happening, but the price that we're paying as investors to buy those future cash flows is a higher and higher premium.
It's getting higher and higher. And it seems to just continue to compound with a lot of these businesses now. And this is a lot, I'm trying to more or less referencing the paper. I'm sure that we could needle and find some quibbles with some of the things it said. And so to me, this is like one of the overarching things that really has reverberated with me as an investor for the past several years, is some of the things Jeff was saying, some of the things that this paper is saying, some of the things that Ben Carlson was saying on your show, is that a lot of the very popular growth in the zeitgeist sort of investments, things that we love to talk about on these podcasts and have actual conversations with people, it's getting harder to find an edge in these businesses because they're in the conversation. It means people are buying them, people are owning them, and not considering some of the other options. It's a lot, to use the cocktail hour conversation, it's a lot more interesting to own somebody like a CrowdStrike, which is a revolutionary company in cybersecurity and kind of a market leader, versus, I don't know, some of the crazy things that I write about on Misfit Alpha, like, I don't know, advanced drainage systems that make septic tanks. Like, nobody cares. And there's not a lot to have conversations about that. And so as a result, we've seen this kind of just a large gravitation as more and more people participate in the market and more people are talking about the market in the online chatter or financial media. Wherever you get your financial news, there's chatter about it. And therefore, it kind of pushes valuations and market participants towards those companies. And more and more companies are getting left to the wayside.
Because it becomes more concentrated and dominated by a smaller and smaller group. one of the things that Cliff Asness specifically called out is the growth of social media. And a big part of the conversation that we've already had it, but he specifically describes it as speed versus accuracy. We've certainly talked about that with quants and these high-speed trading firms. And part of it is certainly social media.
It's hard to deny that social media isn't having a huge influence on the way that people invest today when we have companies like GameStop and AMC. These are companies that have taken on these weird lives of their own as it's hard to describe them really. So AMC Entertainment, seemingly a movie theater company that does a lot of other strange things too. Was it AMC or was it GameStop that bought the gold mine?
AMC.
Okay.
Yeah,
so
AMC
a movie theater with a gold mine and NFTs.
And it's interesting too. I can't remember the exact data point, but it's something I read this week about AMC where they've raised over the past 5 years, AMC has raised more capital in secondary offerings from investors than the company is currently worth.
Well, we know plenty of companies where that's been the case for a long time, but it goes to that idea.
This is one that's done it exclusively in this era of buy the dip, diamond hands, entirely social media driven fandom of these stocks that's completely detached from any like real conversation about the merits of the business. And the stories get tied up in things like what do they call it? Like naked short, the idea that it's being sold short in excess of the float that's available. All the ideas of all these nefarious backroom dealing, dirty deed things that are holding us down, right?
Yeah.
And it's building on the whole thing that we see in the political sphere too, where it's the us versus them, the moneyed interests, the deep state, the swamp versus Main Street. Like a lot of those same kind of psychological constructs are being used, that things that you would think would fire up and kind of flame out over a year or so, that 5 years later, we're still having some of these same conversations. Like, just look at the business.
There's stories about GameStop coming back up again. And this was a company that I think shot up like 200% in a day because a Twitter user, was it Roaring Kitty, posts a photo of somebody like leaning forward with a gaming controller. And we're talking about the most absurd versions of this as an example. Right. And I'm sure that everyone that's listening are more reasonable people, and we're probably laughing at the silliness of a movie theater owning a gold mine. But you and I can use our lives as financial media people as examples here. You have the podcast. I have a newsletter. We have done contract work for Motley Fool and other various financial media. We know what people read, we know what people listen to, we know what people engage with. And a lot of the way that we create media for people is knowing what they engage with and kind of giving them what they want. It's a little bit of that self-reinforcing thing where it's like, well, this article needs to get some eyeballs, so I need to make some conversation related to a company that people care about.
It's a little bit inside baseball, but this is a real conversation. You and I do a lot of videos on our YouTube channel together, short form videos that we do with our affiliate deal with the Motley Fool. And we spend a lot of time having to make hard decisions about, there's things that we really want to talk about that 200 people are going to watch the video versus content that there's a lot of interest for, that thousands of people are going to watch, right? And incentives come into play here, right? I mean, that's the bottom line. We talk about this a ton as investors, understanding the businesses that we own. And if you spend more time on the proxy statement and the annual report than you do reading articles and links on Twitter and Blue Sky and all of those kind of places, you're going to come out way ahead because you understand the mindset of the people that are running the business, right? And where they're making their money and whether they're going to act in the best interest of shareholders or the best interest of themselves if it's disaligned. And it's obvious that's what people are going to do because that's what humans do, not bad people or good people. It's what people do. And it's the same in the financial media or any media world, right? So that's an incentive that we constantly feel tension between producing content that we want to make and finding that balance of doing a mix of both. And it can be really challenging.
Yeah. And getting back to hard, I know we keep going on all these tangents, but I do promise this is all like related around this idea of mispriced stocks. But getting to this idea of if this is the content people are engaging with, there's a pretty good chance that these are the companies that people are investing in or buying in or things like that. And it's not a coincidence that a lot of the engaging content that people tend to associate with tend to be with highly priced companies or companies that have dropped a lot recently. Yeah, I think a great example of this is probably like 5-6 months ago. There was a lot of content produced about Celsius and its atmospheric rise and, kind of meteoric decline. And now it's just hovered in this place, and it's gotten very quiet. And that's very indicative of what you see with a lot of investing is people will gravitate towards these ideas. They'll move them up. And the only reason that they'll start to care again is if they fall pretty precipitously. Companies that just chug along and go slowly and go up at reasonable rates rarely get a lot of attention. Perhaps the one caveat exemption being Berkshire Hathaway.
We've talked about a lot, right? We've gotten up and down on our soapboxes a little bit. We've made a little bit of the case of what the idea of efficient market theory or hypothesis, I should say, and Cliff Asness's less efficient market hypothesis. You say that you lean towards Cliff being, if not precisely, but certainly directionally correct, and which breaks my heart to say it aligns you with some of the things that Jeff talked about, and Jeff kind of being right here.
Hashtag Team Jeff.
So my question is, we need to take this and refocus it a little bit, because it almost feels a little bit like, why try, buy the index, stop paying attention? And I don't think that's necessarily right or wrong. I think for plenty of investors, that is the vast majority of investors should be entirely in index funds. A very, very small percentage should be entirely in a self-chosen portfolio of stocks and fixed income ETFs or bonds or however they want to build it in cash. And then there's probably a pretty good sized percentage that should be like a lot of stuff in index funds, but also a portfolio of stocks that they manage. What I think the vast majority of people that read what you write, what we write, and watch our videos and listen to the podcast do. Where do you come down on as an individual investor, as somebody who's, your professional commitment is to getting into the weeds and studying some of these more obscure companies? Where do you come down? And is this evolving the way you think about being an individual investor?
Well, it does. And I think it's why so much of this is reverberated with me, because we talked about it, the paper, like AQM Capital Management, but the big conclusion takeaway that they had about everything that they mentioned in the paper, I would suggest, we'll put it in the link. I would actually suggest everyone go read it. It's not like a dry, scientific paper. It's actually written okay by financial standards.
It's 24 pages too, so it's not super duper long.
And it's not dense or anything like that. It's more or less like a memoir, if you will, about investing. But one of the big takeaways at the end was basically like, value investing in individual stock picking is likely going to be riskier because of all of the factors mentioned, but will likely have higher probability of rewards over long terms when you have severe market disruption. And that's kind of the thesis, basically. Like, you're going to sit probably idle and things aren't going to look great over longer periods. But those of us who have the discipline to actually have conviction in our ideas and hold on to them, you're likely to have higher returns as a result from individual stock picking.
I want to read this is getting close to the end there. What should investors be doing about this fall of inefficiency over time? I'm going to read this quote from it, because this is exactly what you're talking about. So to quote, the meme stock world, a fever swamp if there ever was one, and if a small subset of the market could prove market inefficiency, which it can't, it would be Exhibit A, gets one thing sort of right. They use an acronym, HODL, for hold on for dear life. Now, they apply it to super low quality, near bankrupt, yet still overvalued companies, often run by scammers playing to and preying on them, and do so using not safe for work language with any who disagree, and various ape images as logical argument.
We just talked about two companies that perfectly describe that paragraph.
Yeah. He goes on. So, that's bad. But if applied to good, intuitive, reasonable strategies you rationally believe in for the long term, HODL is a hell of a motto. That's the end of the quote. So that's exactly what you're getting at here, Tyler.
Yeah. And so for those of us who want to pick individual stocks and not just SPY or die, ride the index for the rest of our lives. For the ones that you actually want to pick individual stocks, the idea being is go do the research, go in the places where people aren't going. go into those individual stocks and off the beaten path sort of places. I know I'm talking my book a little bit, but there's immense amount of opportunities in places people aren't looking for value and good returns because people aren't looking, people don't care. They're spending their time buying AMC or writing 0-day options on Tesla or just plugging your 401k into an index fund. And so for individuals, and the closest thing I'll give to actual advice for people who living 9 to 5 and aren't in the lifestyle, I guess, like you and I are, it is perfectly fine to own a majority of your earnings in an index fund and be a efficient market participant, very much like Ben Carlson was talking about in his work. But obviously, if you're listening to this, you want to pick individual stocks. It's the idea of using a lot of index to grow your wealth. But when you do want to go and pick stocks and be invested in individual companies, you kind of need to be looking in the places people aren't. Jeff's mentioned it before, like, why are you owning NVIDIA individually when you own the bulk of your wealth is in an index fund where probably
so 5% of your portfolio is already NVIDIA.
Right.
Yeah.
And the idea being go get exposure to those other ideas that aren't represented in your portfolio of index funds. And so it's where I started to land on this idea after synthesizing all of these conversation points, is having that, and we'll call it the ignorance insurance, as Warren Buffett would say, with the index funds, diversification, ignorance insurance, and then with your highest conviction ideas in individual stocks, being somewhere that's outside of the normal conversation points or the normal zeitgeist of the internet, I think is going to be one of the more sound strategies for individual stock pickers and people who are looking to grow their wealth outside of just dumping their 401k into indexes and going fishing. Although that does sound kind of nice.
Yeah. There are definitely days that I think that's the case. Looking at you right now in phase as the market starts to open up. But at the same time, I see, hey, there's opportunity here for those businesses, for investors that build a strategy that gives them the ability to act opportunistically, where they have conviction and they have some understanding that didn't come off of a message board somewhere on the internet.
Our message boards, our message boards are great. Those message boards,
That's exactly right. So let's make a pitch for Misfit Alpha. So we'll have the link in there for you to sign up for Misfit Alpha if you want to check it out. There's the free stuff that you have there, which is not a lot of free stuff. There's a little bit, but then the paid research is good. You've been doing a lot more stuff on IPOs, as the IPO market seems like it's really starting to warm up a little bit, and some larger businesses are starting to consider IPOs. So there's a lot of stuff in Misfit Alpha. I want to just remind everybody that's worth paying Tyler to get access to. Plus, you get a little more access to Tyler as well. So that's good or bad, depending on what you.
Well, if you are looking for those individual stocks that are not in the zeitgeist, I can guarantee you the ones that I write about most of the time are not in the zeitgeist. And that's kind of why I wanted to do this. I find these things fascinating. And maybe I'm the only one and I'm shouting into the void, but hopefully there's some people that want to come along for the ride and learn about some really interesting companies that have done fantastically, but aren't cocktail party conversation topics.
Yeah, go check it out, friends. That's for sure. One thing I want to add too that I think it's something that I've been using more as my portfolio has expanded to beyond just stocks and cash, as I've increased my exposure to bonds and that kind of thing. And there's a good chance that everybody out there that's listening to this, that your 401k through work, you probably have, your market index stock fund, and you have your bond fund, and you might have like an international stock fund too. You probably got real estate. So like there's probably 4 or 5 different buckets you have your money in. And I've really come down very firmly on the side of, if you are investing with that as part of your strategy across these different asset types, rebalancing at least once a year, probably like every quarter, can be really, really useful. When the market bottomed in mid-April, was I buying more stocks with cash? But I was also shifting in some other retirement accounts that are all, like, my wife through her employee 401k plan that's all ETFs, index funds, and bond funds. We rebalanced. So the market had come down. So the percentage that was in stocks had fallen. So we allocated some of the bonds back into stocks. So we bought the dip. So there's a way you can even do that if you are just investing with index funds and ETFs, that you can still be opportunistic. So I think building that toolkit broadly and being willing to think about reevaluating and making changes as your strategy changes and your life goals get closer to you or further away. If you have a kid, it's like, hey, there's another goal that just showed up. I got to pay for somebody's education. It's constantly reevaluating your strategy, making sure it fits your life, fits your mindset, and is working for you.
I have nothing else to add.
Wow. Thanks, Charlie.
I didn't know where to go or on that. I thought you wanted me to riff on it, but I was like, that all works.
There you go. Let's do this. What's your 3 bullet point takeaway for individual investors out there?
3 bullet points. Well, reluctantly, Jeff was right. The second one is sort of. The second one being, there are opportunities. They're just harder to find. And those who look for them and can hang on to conviction without having a large conversation about them all the time are likely to find strong winning companies for the long term.
All right. We're going to call it here. We're done.
That sounds like a good ending right there.
All right, Tyler, this has been a lot of fun, and let's commit here together to do this again in July and not miss an entire month with our Misfit Monthly.
We'll do our best. Life happens.
Fair. That's as close as a commitment you're getting from me too. So everybody, thanks for going along on this ride with us. And always, as we say on Investing Unscripted, we love to give our answers, give our deep thoughts and insights about things like less efficient markets and how we can succeed. But our answers are not necessarily your answers. It's up to you to find the right answers that make sense for you, your investing, and your family's wealth. You can do it. I believe in you. Tyler, we'll see you next month.
See you next month.